Okay. Since we are starting a new chapter, let's go back and look at the schedule overall, knowing that, so we're back on schedule, okay? We should be able to get through everything, and of course the weather is going to be beautiful from here on out, except for Friday, where apparently we're getting storms. But let's see here. So we had our midterm. We're going to start chapter 1 today. Next week is spring break, so don't come in. Enjoy your time off or use it to get caught up or whatever It's the whole week. Yeah, so there are no classes at all next week at DMAC. So any of your other classes also. Now, if you're taking online classes, it might be a little different because we don't really technically, I mean, we have the same schedule, but online is just kind of continuous. So, but in-person classes will not meet at all next week. Okay. So yes, your final deadline for, if you have any outstanding assignments for chapters 1, 2, or 3, final deadline is tomorrow night. It's still reduced credit, but you know, a point is a point is a point. So I would encourage you, if you have anything outstanding, do whatever you can, right? Also, the extra credit. Also, deadline for chapter 1, 2, and 3 is tomorrow night. So again, it will be reduced from the maximum credit because it's late, but you still get some points for it. So I would encourage you to do that. Like I said, no class next week for spring break. What am I doing here? There we go. We will have 4 days to get through chapter 4, and I just looked at all the material and kind of reassessed, and we should be good. We should be all right. Why did I put last day to drop there? Let me double check that, because I don't know if I was looking at the wrong. So let me double check that. I'd send that out, and I have it on my calendar. Somebody put it on my calendar that today was the last day to drop. Maybe it's for a different term. So let me double check that, and I'll send out a message about it. But that's where we stand. So, and this, like I said, this gets us right back into our normally scheduled programming after all of those snow days. So we'll get to work on starting on chapter 4 today. Chapter 4 covers income tax withholding. So we talked about, Social Security and Medicare tax withholding and how we do those calculations. Income tax withholding is different from Social Security and Medicare tax withholding. A little more complexity to it because everybody's income tax situation is different. There are some more complex calculations that go along with it. Today we're going to kind of do an introduction to the income tax withholding, talk about what types of income are subject to income tax and therefore income tax withholding, talk about types of income that aren't subject to income tax and therefore are not included in the calculation of how much to withhold. Okay, so that's what we're going to do today. Any questions before we? Oh, all right. I do have a little intro video. So in the in-class activities there, only look at today. I haven't updated I kind of carry this over from semester to semester, and so that's why you still see, well, I guess I have the dates right, but the times are different. So it kind of carries over from the fall semester, but then I make adjustments to it as I'm updating it. But today, we're going to start by watching this little of how did we start paying income tax? Which is such a fun topic. Hopefully we can hear it. Hold on here. Ooh. Sorry.
you received your first paycheck. I was pretty excited, I'll be honest. I worked for weeks and weeks in there, and the sealed envelope was my very first hard-earned compensation, and I had so many plans about what I was going to do with the money. Those hopes were brutally dashed the moment I read the bottom line. By the time the money actually got to me, it had been sliced up like a pizza. An alphabet soup of government agencies each got their cut before I did. But what are taxes anyway? How do they work, and how did we end up with this present system? First things first, the basic idea of taxation is pretty simple. There's some sort of state or similar authority that imposes a levy on an individual or a legal entity, like a corporation or something. If you can't pay, then you can be charged with a crime. This is a very old concept. It dates back as far as Mesopotamia and Egypt's old kingdom. Nowadays, the taxman is not going to beat the crap out of you for being late, but the system is way more complicated. In the United States, the taxes you pay vary from person to person, from company to company, from check to check, and then from state to state. However, most people do have to pay federal income tax. And the U.S. tax system is huge. Complex doesn't even begin to describe it. A better word would be Byzantine, which I looked up earlier. In 1913, Congress passed the 16th Amendment, and the 16th Amendment says this specifically: the Congress shall have power to lay and collect taxes on incomes from whatever source derived, without apportionment among the several states, and without regard to any census or enumeration. Okay, let's be honest. While most folks in the U.S. only think about taxes when April approaches, the process really begins when you start a new job. You and your employer agree on your compensation or before tax income. Next thing you do is fill out a form called the W-4, and it determines how much income tax your employer will withhold from each check. Why do they do this? Good question. Employers are required by law to withhold income tax and deposit the money in a Federal Reserve Bank, and this is how the federal government maintains a steady stream of income while also drawing interest on your tax dollars. Pretty clever, huh? So instead of paying taxes once a year in April, you're actually paying them all year long, every time you get a paycheck. The rules change when you're a freelancer or an independent contractor or you're otherwise self-employed. Nobody's going to withhold income taxes each time it gets paid by a client or a customer, so it's up to you to manage what you owe. That's a good way to think of income taxes. Let's think of filing income taxes in April, kind of like settling up with the IRS. All you're doing is figuring out if you pay the right amount of cash. If you pay too much, boom, refund. If you pay too little, boom, you're writing another check. Income tax forms like the 1040 are notoriously confusing, but that's because they're based on a code that's more than 5,000 pages long, because somebody thought that would be a good idea. Presidential candidates are always talking about revising the system, but how, right? Well, there are all sorts of potential alternatives, like, for example, this thing called the flat tax. Under a flat tax system, everybody pays the same rate. So proponents of a flat tax system say that it would do away with all the complicated codes and forms. Critics say this system favors the wealthy, and that's not the most controversial idea. There's another one. It's even more controversial than the flat tax. The idea that we should just repeal the 16th Amendment altogether, abolish income tax, don't worry about it. In place of income tax, then, they would have a national sales tax. So many countries around the world already levy a national sales tax. You've heard of it before. It's called a value-added tax, or VAT. The difference is that most of these countries also collect income tax. U.S. backers of this plan want to get rid of the IRS and charge a flat 10 to 25% on all retail purchases of new goods and services. So people who are fans of this say that a consumption tax collects revenue from everybody, even illegal residents, tax dodgers, tourists from other countries, etc. Opponents say that it puts an unfair burden on the middle and lower classes who buy a lot of the stuff that will be taxed. They also say it might reduce consumer spending, slowing the economy down. And then they add that in order for it to be fair, it would have to be applied to the purchase of stocks and bonds in addition to consumer goods. Yeah, so it's no secret that taxes are a bitter subject in many countries. And the United States has had at best, a rocky relationship with this issue. The U.S. doesn't just have one of the most complicated tax systems in the world, also grows more complicated each year. This is a politically charged divisive issue, but there is one thing that everyone can agree on. The current system is not perfect. So here's a question. What would you change if you were in charge? Let us know in the comments. Go ahead and like and subscribe.
All right. So just a little bit of background. And of course, this video is a couple years old, and so there's a lot of talk right now about getting rid of the income tax system entirely and replacing it with tariffs, which is a hot topic right now. So we'll see what actually happens. But for our purposes right now, we still need to figure out how to calculate those income taxes. So we're going to start talking about that today. So let's take a look at our chapter. All right, so our learning objectives in the chapter, we're going to talk about who is subject to federal income tax withholding. And here we're talking about the withholding. We're not talking about individuals filing their tax forms in April. Oh, you know what? Before I get started, I forgot I had these. I don't know if these would be helpful or not. I just put together a little notes page. So it kind of has an outline of what we're going to talk about. It's got some places for you to make notes. It's got, yeah, you're welcome. Just to kind of help follow along with all of the topics. You're welcome. We'll see if that works at all. I'll have to, if it works well, you'll have to remind me to make others for the rest of the lectures. So who is covered by the federal income tax law, meaning who is subject to withholding? And again, so what we're concerned with as payroll professionals is taking out those prepayments of income tax with every paycheck. Individuals are responsible for filing their tax returns in April, and they take the information, how much has been withheld over the course of the last year, and those prepayments then are applied to what taxes they owe in April. But for the payroll professional, we have to do a calculation of how much needs to be withheld. And like the video had said, you know, every individual is different. It varies state to state. It varies from person to person. It sometimes even varies from county to county. And so it's, you know, it can be a rather complicated undertaking to do those calculations. But the first thing we have to do is establish who exactly do we need to withhold income taxes for. So we'll talk again really briefly about that employer-employee relationship, because we've already gone over that several times. What we define as wages for purposes of income tax. So what we're talking about here is, you know, what is our base? Remember, we had base times rate equals the tax. Here we're determining what is our base. So who is subject to income tax withholding? What kind of payments are subject? What kind of wages or payments, including wages, are subject to income tax withholding? And then we're also going to talk about certain types of pre-tax salary deductions. So there are amounts that employees may pay, certain items that are deducted from their pay, like health insurance or retirement contributions, that actually reduce that tax base. So the amount that is being taxed. So we'll go through that and talk about this pre-tax. We are going to talk about the W-4 form, which was mentioned in the video as well. Many of you are probably familiar with it if you have a job or if you've had a job in the past. It's the form that is filled out at the beginning of employment and continuously throughout employment as circumstances change. And it tells the payroll department how much income tax withholding needs. It gives the payroll department the factors it needs to know, the information it needs to know in order to calculate income tax withholding. So it's a very important, crucial component of our calculations. Then we're going to get into actually how we calculate how much income tax should be withheld. There are a couple of different ways of doing this, a couple of different methods of calculating income tax withholding. And the reason we have two different methods is because for some income levels, some higher income levels, we can't use one of the methods. So we have to use the other method. The two methods are referred to as the wage bracket method and the percentage method. Okay. One of them is pretty simple. We just use a table. We take all of that information from the W-4, and using that information, we plug it into a table, and that's how we can determine then how much income tax to withhold. Fairly simple. But once we get to an advanced or higher income level, we can't use that table anymore because tables are limited, right? They're only going to go up to a certain amount. So at that point, then we have to use this, what's called the percentage method, in order to do a more complex calculation of what the withholding is. Again, we still use all of that information from the W-4 in order to make that calculation, but it involves some calculations on our part. With the table, the calculations have already been done, right? You just look at the table and triangulate and figure it out. With the percentage method, though, you have to do those calculations yourself. And so we're going to go through those methods as well. Then we're going to talk about as well the W-2 form. And again, if you have had a job or currently have a job, you probably know what a W-2 form is. If not, it summarizes all of the information, all of the income that you've received during the year from one job. So for each job that you had during a year, you would receive one of these W-2 forms. The W-2 summarizes how much you were paid and how much withholding you have had. So how much in prepayments you have made toward your taxes. It also summarizes the amount of Social Security and Medicare tax you've paid, as well as the state income taxes that have been paid. And it also includes information about deductions that have been made. So if you paid for health insurance through payroll deduction, it would summarize how much you paid in health insurance, how much was deducted from your paycheck in order to make those payments. We're also going to talk about certain types of information returns. So the W-2 is a type of information return. An information return is a return, a form that summarizes activity that has occurred during the year, and it's used so that individuals can prepare their individual tax returns. Other types of information returns would include 1099 forms. There are all sorts of different types of 1099 forms. 1099 forms, the one that we're mostly concerned about would be called the NEC form, non-employee compensation. So what do you think that would summarize? What type of income if it's non-employee compensation? Exactly. So contractor, how much has the contractor been paid during the year from one particular payer? That's a 1099 NEC. Now, there are other types of 1099s. And you don't have to remember this. We'll go through a long list, and it's kind of just an overview. When you take income tax accounting, you'll become a lot more familiar with the different types. But just as kind of an introduction, some of them, 1099 INT reports the amount of interest income that somebody has earned during the year. 1099 DIV, the amount of dividends that somebody has earned during the year. 1099B reports stock transactions, gains and losses from stock transactions. There's a whole long list of 1099s. 1099G is from the government. It reports government payments. So unemployment compensation would be reported on a 1099G. Also, state income tax refunds are reported on a 1099G. Like I said, there are a whole bunch of them, and we're going to talk about those. Then we're going to look at the state and local income taxes, because that is important. As a payroll professional, you have to not only be familiar with how the federal government calculates federal withholding. If you're in a state that has income tax, or in a county or a city that has an income tax, you also have to be familiar with the rules for withholding, income tax withholding for those jurisdictions as well. Also, you might be, if you're in payroll and you work for a company that has locations and employees in different states, you'll have to be familiar with the rules in different states. So you may be located in Iowa, but if your employer has employees in Michigan, Ohio, Illinois, Minnesota, you got to be familiar with the rules in those states as well. So it varies state by state. We're not going to go into detail on any other states. We will talk about Iowa though, and Iowa's actually in the middle of some changes. I think I mentioned this earlier in the semester. Iowa's in the middle of changing to a flat tax, what was mentioned in the video. And that actually starts to take effect, I think it's this year. I think originally it was supposed to be 2027, then they moved it up to 2026, and I think, don't quote me on that, it's either this year or next year when it starts. And then we have this supplement that if we get time to do this, we will do it. In the supplement, so there are, like I mentioned, there are two ways to calculate income tax withholding. There's also a whole different regime for calculating income tax withholding depending on the year that the W-4 form was filled out. W-4 forms from 2019 and earlier, which may still be in effect. If you're an employee and you've been an employee for the past 7 years and you filled out a W-4 form when you started working back in 2018, your W-4 form would be from this old regime. And there's no requirement that you fill out a new one, a newer form. So prior to 2019, there was a different way of calculating withholding. The reason for this change is there was a big tax law change in 2017. With those tax law changes, better known as the Trump tax cuts, you've probably heard of them referred to that way in the media. Those tax changes caused forced a change in how we did the calculations for withholding. Okay, so we've got this old method, this old regime, and now we've got this, everything from 2020 and later is under the new regime and the new calculations. So a lot of employers have mandated that their employees change their their W-4 anyway, have had them fill out a new one, but there's been no requirement that people do so. So there may still be older W-4s out there where you have to do the old calculation. Okay, so that's what the supplement or the appendix is in this chapter, and hopefully we'll have time to kind of take a look at that. And we can do the calculations for those as well. All right. So employer-employee relationship has to exist in order for the employer to withhold income from an employee's wages. So again, that employer-employee relationship, we're going back to the discussion about, are you an independent contractor or are you an employee? So if an individual is an independent contractor, obviously that employer-employee relationship does not exist. And so income tax withholding is not required. So partners in a partnership, same thing. It's not an employer-employee relationship because the partner is also the employer. So there would be no federal income tax withholding. However, employees in that partnership, there would be an employer-employee relationship. And so income tax withholding would be required. So I'm not going to go through that. And then they talk about, going through and looking at chapter 3. That was really covered in a lot of detail in chapter 3. So we're not going to go through all the details of that. Just kind of remind yourself, yes, that that distinction between independent contractor and employee is what they're talking about here with that relationship. Statutory non-employees, these are just kind of a special category of people. They're not employees, but they sort of are. They're kind of in the middle. It's only people who are direct sellers and certain real estate agents. In their cases, they do not have, they're considered employees sort of for Social Security, Medicare tax purposes, but not for federal income tax purposes. So they kind of fall into a different gray area. We don't go into much about those. That's just kind of an FYI. All right, so a lot of these things should look familiar to you. There are a lot of the same, the types of income that are subject to income tax withholding are very similar, and in most cases overlap entirely with what is subject to withholding for Social Security and Medicare tax. I say almost entirely because it's not exclusive. There are one main difference that really concerns us. So wages and salaries, obviously. Wages and salaries are subject to income tax withholding, just like they're subject to Social Security and Medicare tax withholding. Vacation pay. So if you go on vacation, you still are subject to income tax withholding. Also, certain types of vacation awards. There are employers out there that will give, it's like a type of bonus for employees. They may get, like maybe they've been there for 10 years and they get a trip, they and one other person get a trip to Maui for a week to celebrate their 10-year anniversary. That would be nice, wouldn't it? I'm pretty sure DMAC doesn't do that. The value of that vacation is considered earned income, is considered a wage, and would be included. So they would have to pay tax and have withholding on the value of that award. Okay, because if they gave a bonus and then the person went to Maui with it, that bonus would be subject to income tax withholding as well. It doesn't matter that it's not cash. There are certain types of non-cash payments that are still subject to income tax withholding. Any supplemental payments, I can't think of an example that's something other than a bonus or a commission, but like those, I guess those, well, I guess that falls under bonus. So those bonuses were like the safety award sort of thing. You didn't have any accidents, you know, Homer Simpson, who didn't have any accidents for a week, and you get like a $90 bonus or something in there. I suppose that might be included as a supplemental payment. There's probably a better example out there. I just can't think of one off the top of my head. Bonuses and commissions. We talked about those. Those are still subject to federal income tax withholding. Tips as well. Tips that are reported as actual tips. Tips that are allocated tips, there is no requirement to withhold federal income taxes on. So remember, those allocated tips are ones that are calculated based on the sales of the individual. If it's an allocated tip, it's not subject to federal income tax withholding. But if it's an actual tip, if you're reporting to your employer, hey, I made $573.23 in tips last month, I know exactly how much I made, that then would be subject to federal income tax withholding. That amount would be reported to the employer. The employer would withhold on those tips. Cash awards are included, and also certain taxable fringe benefits. So that's actually, I guess the vacation allowance was more, the example I gave you for the vacation allowance probably falls more under this. That would be like a fringe benefit where you get a vacation. That's considered a taxable income though, and you have to, the employer is required to withhold on that. Here's a list of certain types of taxable payments, specific types of taxable payments to employees. So disabled workers' wages. So these are, if wages are paid after the year in which the worker became entitled to disability insurance under Social Security. So these are kind of like delayed wages. Those are still subject to income tax withholding. Drawing account advances. So there are certain careers. These are usually sales careers, and I think we may have touched on this in another lecture. Sales careers where you have a certain salary, but your commissions are supposed to cover that salary. But then when your commissions don't cover that salary, you have to take what's called an advance in order to meet that salary. So if your salary is $2,000 a month, and you're supposed to earn $2,000 in commissions a month to make that salary, but you don't earn $2,000. You only earned $1,800 in that month in commissions. Well, now you're kind of $200 in the hole. Your employer still has to pay you the $2,000. But now that $200 is going to offset in a future month those future advances. So any of those advance payments to salespeople against their commissions or unearned salaries. So even though you only made the $1,800 of commissions, you're getting paid the $2,000. That advance of $200 is taxable. It's still withheld. Yes. What is a who?
Mayor.
A mayor of a town? Yeah, they would be considered, if they're paid, if it's not a volunteer position, they would be considered a employee of the city.
I saw this thing that said the mayor of Chicago that
receive gifts?
Mm-hmm.
Yes.
And that they were not properly.
Yes.
And that there was a lot missing from the gift room that were
right.
gifts that could be for his wife.
Yes. So he's gotten himself into some trouble over that. And those who are in public service would have additional requirements over and above reporting it to the IRS. They probably have rules against accepting a certain value of gift. Like if they receive something, they probably have to hand it over to the city, or they just can't accept it at all. At a minimum, everything would have to be reported so that the city knows what's going on. Because obviously there could be some favoritism. If he's getting a gift from a construction company and then he awards a contract to that construction company, that's quid pro quo and that's illegal.
What about
Yeah, they do, and they have similar requirements.
But they don't always report it.
No, they don't. No, they don't. So what people do, what they're supposed to do, oftentimes there's a divergence there between the two. So anyway, those drawing account advances, usually they're for salespeople. Gift certificates. So if your employer gives you a gift certificate, here's $100 to go out to dinner with your spouse, that's considered income because it's a replacement for cash. And it would be considered, it would be included in taxable wages, so subject to income tax withholding. Meals and lodging, we go back to this. Is it for the employer's convenience or is it for the employee's convenience? For the employer's convenience, it's not a taxable benefit. If it's for the employee's convenience, then it is a taxable benefit. So if the employee is choosing to take that benefit, then it would be included, the value of that would be included in their taxable income. And so you do have to, in those cases, you have to figure out what the fair market value is of these items.
What is an example of that? Like, if you're here working, you decide to buy something or what?
So an example of that would be, say you're a hotel manager, and the hotel allows you to have a room. You're not required to, but there's a room available for you so you can stay on the premises if you want. You're welcome to eat the food or not, so it's the employee's choice. In that case, the value of that room and the food that they eat would be included, the value of that would be included in their taxable income. If, however, the employer says, well, in order to be a manager here, we want you on site 24 hours so that you can answer any problems, be there for any problems, you have to stay here, and we need you, because you have to stay here, you also are going to be eating here. Now it's the employer that it's for their convenience, right? That the manager's there, then it would not be a taxable benefit. So it all just has to do with whose benefit it is, right?
So it would not be a taxable benefit, so the employer cannot tax you for that. That's not included in the wage.
It's not included in your wages. Exactly. The value of that is not included in your wages in that scenario. Whereas if you have the choice, then it is. You know, if it's up to you or you're asking for that benefit, then it would be included as taxable income. Partially exempt employment. So if the employee spends half or more time in a pay period performing services that are subject to employment taxes. All right, so this one's kind of weird, and in real life I've never come across this. However, I could see that it could probably happen. Let's just say that I work for DMAC. I'm an employee for DMAC, but I'm a half-time employee for DMAC. But I also do some consulting work. And I'm consulting, I have a business and I'm consulting for DMAC, I don't know, on what software to offer to students, something like that. If I'm spending half or more of my time with DMAC as an employee, then that consulting income is also considered to be employment income and would be subject to withholding. If I'm spending 30% of my time working as an employee for DMAC, but the other 70% is my consulting, then it would be divvied up between, so I would be a 1099 employee or an independent contractor for that 70% of the time. 30% of the time I would be considered an employee. So only the 30% would be subject to withholding. But once my total time with DMAC gets to half, all of that income is considered wages and would be subject to withholding. So the key dividing point there is half. Does that make sense? This is when I have two different or more different responsibilities or roles with an organization. Payments to non-residents, doesn't matter, it's still subject to withholding. And it doesn't matter if they're legal residents or not legal residents, it's still any payments that fall under the still like the wages, all of the other definitions, still subject to withholding. Yeah. Yeah. So if they're what? Well, I mean, that's another common way of saying it. So, and those are the authors. Those are my words. Scholarship. So if you receive a scholarship and in exchange for that scholarship, so you're at an educational institution, you receive a scholarship, but in exchange for that scholarship, you have to do some sort of work. You have to teach or you have to do research or something like that. Then that's considered wages and subject to income tax and income tax withholding. If the scholarship is free and clear, you don't have to perform any services for the educational institution, then it is non-taxable and would not be subject to withholding. Sick pay. So sick pay, if it's sick pay like it's just part of your employee benefit, that's subject to withholding just like any other type of wage would be. If it's sick pay that's considered to be like disability pay, whether it's subject to withholding or not depends on whether the premiums when they were paid were pre-tax or post-tax. So whether you had to, so if you did not receive a tax benefit from the payments when you made them for the premiums, then it would be non-taxable because you've already been taxed on the premiums. If you didn't, or if you did receive a tax benefit, so it reduced your taxable income in the future, then it would be subject to withholding in that case. And that goes a little bit deeper than what your book goes. Probably gave you more information than you needed there. Supplemental unemployment compensation. So unemployment compensation is subject to withholding. There was a time for a couple of years there during COVID when it was not. It was not taxable and it was not subject to withholding. That is no longer the case. We are back to the original rules, and unemployment compensation is considered because it's a replacement for income that would be subject to income tax withholding, right? So in that case, it is still subject to withholding. And then travel and business expenses. So this is what we're talking about here are employers that reimburse for any travel or other type of business expenses. So if you have to drive for your job and the employer pays you for your mileage, that sort of thing. So if the employee is not required or does not substantiate expenses with receipts, then it is subject to withholding. So in that case, so if you're, and commuting also wouldn't count. So anytime you're going from your home to your job, that's considered commuting. That is not a benefit that an employer would pay, and it's not, so therefore it's also not a deductible type of expense. But what we're talking about here is like during the workday, if you're driving or traveling or incurring some expenses on your employer's behalf, in order for it not to be taxable and therefore not subject to withholding, sorry, my throat's getting dry. You have to have receipts. The employee has to have receipts, and it has to be required by the employer. In that case, so for example, DMAC, I had to go up to Story City last week in order to do an observation of one of the high school career academy teachers who was teaching accounting. My employer told me I had to do that. I'm going to get reimbursed for that mileage. Because I will substantiate it and because my employer is requiring me to do it, I will get reimbursed for those miles, and I will not have to pay tax or have withholding on that reimbursement amount because I'm just being reimbursed for expenses that I incurred while on the job. If I didn't have a receipt, I mean, my receipt is, I didn't buy gas or anything. My receipt is the documentation. Or if DMAC said, or if I just chose to do it on my own, then I don't. And if DMAC still reimbursed me for it, I would have to be taxed on that money. It would be considered wages, essentially, that I'm going to have withholding from. Also, if the employee receives some type of travel advance that does not have to be repaid, so for example, they're sending me to, let's say they send me to a conference in Miami, and they give me $3,000 and they say, here's $3,000, you make the arrangements, you buy the plane ticket, you pay for the hotel, all that, here's $3,000 to do it. But it only costs me $2,000 in order to do all that. The extra $1,000, if my employer says you can keep it, that's going to be taxable income. That $1,000 will be taxable income if I don't return it. It'll be subject to withholding. Only the $1,000, because the $2,000 I'm using for business expenses. But if I'm coming out ahead, the difference is going to be taxable income. Yeah, you would need to provide. Yeah, you still have to provide that to the employer. Okay, so and obviously this is not an exclusive list. This is a summary of different types of items that are, and many of them not cash items. There's something, some of them are non-cash items that they're still taxable. Yeah. Oh, it does not include, so if you were terminated from your employment because you got fired because you didn't do your job, then normally what happens is you're not eligible for unemployment benefits anyway. If you cannot intentionally, like if it's because of your behavior on the job and you got fired, it's usually because maybe they've downsized, like they're gonna lay people off because they just don't have the work. Then you would be eligible for unemployment, but you can't apply for unemployment, or you can't receive unemployment if you just quit your job voluntarily. You don't receive unemployment, or if you got fired because of your behavior. So, and then the age, I would assume, well, if you were terminated because, retirement. Yeah, if you retire, then you're not eligible for unemployment benefits. I think that's what they mean there. Yeah, yep. All right. What are we doing on time here? So 1:40. Okay, so fringe benefits, and I talked a little bit about these. I've already given you a little preview. We'll go into some more detail. So fringe benefits are subject to income tax withholding unless they are excluded. So you can assume that any type of fringe benefit, and this, with a fringe benefit, what I'm talking about is something the employer provides to the employee, and it's usually a non-cash benefit. Okay, so, but the important thing is it's the employer is providing it. Okay, unless it is specifically excluded, it would be considered taxable. The value of that fringe benefit would be considered taxable. There's a list of things that are certain things that are non-taxable. This again is not exclusive. So this would be one of those things that's excluded. Oh, and also it's the fair market value of the benefit minus any payment made by the employee. So if the employee had to pay something toward it, you'd subtract that out. So meals, if it's for the employee's convenience, let's say the employer gives them a 50% discount on the meal. So the employee has to pay 50% toward that meal, right? So that amount of payment would be excluded from being a taxable benefit, but the other 50% would be considered a taxable benefit. So that's what they mean by minus any payment that was made by the employee. Certain non-taxable benefits, services provided at no additional cost. I think one of the examples that your book gives is an airline. So if a lot of airlines will allow their employees to fly for free if there's a seat available, right? If there's just an empty seat, not really going to cost the airline anymore. I mean, the amount of extra fuel that they use is going to be negligible. You can't really calculate that. That would be a service that the employer is providing to the employee, and it doesn't cost the employer anything to do that. That would be non-taxable. That would be a non-taxable fringe benefit to the employee. So the value of that flight would not be included for calculating income tax withholding. Qualified employee discounts. So employee discount, I think it's up to 20%. More than 20% is supposed to be taxable. Use of on-premises athletic facilities. So DMAC has a gym up on Ankeny campus. Employees are allowed to use that gym. We're allowed to join that what is it, Trail Point? And it doesn't cost us anything. If we join that gym, it's free. It doesn't cost DMAC anymore for us to use it either. But if we join that, because it's on DMAC premises, it's not taxable. The value of that is not taxable to us. I don't know what a membership costs, $50 a month, something like that maybe. That's not added to our paycheck. The value of that is not added to our paycheck, so no income tax withholding occurs because of that. If, however, they provide, and I guess this will be on one of the other lists of things that are excluded, if the athletic facility is off premises. So instead of, they also provide us, one of the benefits is they'll pay, I think it's $10 a month, $10 a month toward a gym membership elsewhere. So any gym that we want, if we provide the receipt, they'll give us $10 a month back for our fees. But that $10 a month is taxable to us. So that is added to our taxable income for the calculation of income tax withholding. So that there's a difference there on whether it's on premises or off premises. Reduced tuition for education. So I'm trying to think if which ones they're talking about here. An employer can provide up to $5,250 of tuition reimbursement to employees for anything, and it's considered not taxable to the employee. So if the employer reimburses up to $5,250 for tuition, that is considered non-taxable. Anything over that would be taxable. Other working condition fringes, I don't know, parking on site. So I get to park when I'm here. That's considered to be a fringe benefit. The fact that my car has a place to sit while I'm in here. The value of that is not considered to be taxable. So, and there's a whole list of them, it says in the circular E there. So there are, however, other fringe benefits, and let me see, are they going to give us a list? I thought they usually do. They haven't. Hold on a second. This is, I've got this, I'm gonna put this up here just so you can see it. Again, the black markers are all gone. This is up there this is in Canvas, but this is probably, we're going to be talking about some of these other items. Right now we're talking about fringe benefits. Actually, I'm not going to write it down. Yeah, I think I will. And I've got a table here. So for fringe benefits, these are things that the employer provides. Some fringe benefits are taxable. So the value of that fringe benefit is going to be added to the wages in the calculation of withholding. Some fringe benefits are not taxable. That was the list that we just saw. So those athletic facilities on premises, and I can't remember what the list was, but that list that we just saw in the previous slide. Non-taxable, this means that they're not going to be, the value of them is not going to be included in the calculation of federal withholding. Okay, they're just something you get, right? We have this other category of employee paid fringe benefits. So over here on the left, the employer is paying for it. Whether it's taxable or not taxable, the employer is paying for it. That's a fringe benefit. Then there are employee paid fringe benefits. So this is coming out of the employee's pocket from their paycheck. There are two categories of employee paid fringe benefits as well. Some of them are post-tax, which means you do all the calculations to get to net income. You subtract the Social Security and Medicare tax, you subtract the income taxes, and then at the end, you subtract the benefit. That means you're not getting any type of tax benefit from these. So post-tax benefits are of no tax, they don't affect the income tax withholding for the employee. Then there's a category of employee paid fringe benefits that are pre-tax. For these, you subtract the amount that is paid by the employee before you calculate the tax. So it's going to reduce the amount of taxes that are withheld from the employee's paycheck. Okay? So this is a good table to kind of delineate these four different items. Again, employer paid on the left side, employee paid on the right, exempt and non-exempt, or non-exempt and exempt, and then post-tax and pre-tax types of benefits. So these four categories, the only time, so the best type of benefit would be this one. This is somebody else is paying the benefit and you're not having to pay any tax on it. That's pretty cool. Somebody else is paying. This would be, an example of this would be employer paid health insurance. So if your employer pays any portion of your health insurance premiums, that is non-taxable to the employee, and the employee is not paying for it. Also, employer portion of retirement benefits. So if you are part of a 401k where the employer is putting some money into your retirement, that's non-taxable. At least right now it's non-taxable. When you draw it out, it'll be taxable, but it's not going to be added to your taxable wages, and the employer is paying it. So essentially, this one here is free money, pretty much. That's the best one. Over here, the employer is still paying for it, but you're going to have to pay tax on it. Here, the employee is paying it. At least here, with the pre-tax, you're getting a tax benefit. You're going to reduce your taxes. Post-tax, though, you have to pay it, and your taxes aren't getting reduced. Okay? So what we're mainly talking about right now are these employer-paid fringe benefits. So there are a couple of different ways that the withholding can be done on fringe benefits. One is that you can value them separately and then withhold at what's called a supplemental wage rate. It's easy, 22%, just a flat 22%. So you take the value of it, it's like a separate paycheck, and then the flat 22%. Or, and this is the more common method here, you value the fringe benefits and add them to the regular wages. This is a little bit easier because you've actually got some money to draw from, right? Otherwise, if it's a non-cash benefit, you're somehow going to have to collect that withholding from the employee. But with this one, you're just going to add it to their regular wages and treat it as one paycheck. So, for example, let's just say we have wages of $1,000, and we have some sort of fringe benefit. I'm just going to call it a fringe benefit of $100. This means, and this is taxable, fringe benefit has a value of $100. That means when we're doing our withholding calculation, we're going to use $1,100 as our calculation. This is our gross wages that we're going to use to do our calculation for withholding. Not the 1,000. We've got to add that 100 to it. That's the most common one, and then it's not going to be taxed at this flat 22% rate. It's going to be taxed at whatever the rate would be for this $1,100. Just the normal withholding calculation, which we will get to. Okay? You also have the option of treating the benefits as being paid on one date, or you can spread it out. Spreading it out is also very common. So, for example, I have some friends that actually work in the athletic department at Iowa State, and as employees of the athletic department at Iowa State, they can be members of the country club up in Ames. Well, the value of that is a taxable fringe benefit. So the value of that membership gets added to their wages. It's spread out over the course of the year, though. It's going to be spread out over, I don't know how often they get paid. Monthly? I think they get paid monthly at Iowa State. So it's going to be spread out over 12 months. So if the value of it was $2,400, $200 would get added as a fringe benefit, and it will increase the taxable amount. Okay? Oh, and they use the example here too. So $2,000 value of country club membership, you can do it all in one chunk, or you could spread it out over, they have 4 paychecks here, but normally maybe it'd be over the whole year. All right, tips. All right, so we go back to the if more than $20 a month is considered to be wages, they have to report, or $20 or more a month, they report it to the employer by the 10th of the following month. So, and then the employer will collect income tax and Social Security taxes on reported tips. So if it's actual tips that they received, we know they received these tips. For food and beverage establishments with more than 10 employees, the employer is going to allocate the tips, and then they will not withhold taxes on the allocated tips. Only the actual reported tips. Now, the employee is still going to have to pay tax. They still have to report the tips. It's going to be added to their wages. They're going to have to pay it, though, in April when they file their tax return. Or they're going to have to increase the amount of withholding on their paychecks in order to make up for that. Okay? So they talk about 3 different methods of allocating tips. You can use hours worked, gross receipts, or some agreement between the two parties, as long as everybody is has an understanding of how it works. So gross receipts is probably the best way. So we're going to withhold, or we're going to assume that you got 8% tips on, you got tips on 8% of your gross receipts during the month, and that's what we're going to apply as tips. And then we're going to withhold Social Security and Medicare taxes, but we're not going to withhold income taxes on that. Now, again, like I said, that doesn't mean they don't have to pay income taxes. It just means it's not going to be withheld. Okay. All right, I already talked a little bit about this, but I didn't really distinguish between an accountable plan and a non-accountable plan. So a lot of employers will reimburse for travel expenses if they have to send an employee to a conference or a meeting or something like that. An accountable plan is a plan that it's actually just a document that outlines what the rules are for getting a reimbursement from the employee. And it's not a plan that they send into the IRS or anything like that. It's just something that the employer has on file that says, these are the things we're going to reimburse for, and we do collect receipts for these items. It's a pretty easy thing to have for employers to have. It's something you can find a template for one online and just download it. If travel expenses are reimbursed under an accountable plan, so they fit under that category of accountable plan, then there is no income tax withholding on those amounts. So this, like I said, this is a very easy thing for an employer to do. They don't have to hire an attorney to draw one up, and they don't have to file it with the IRS. It's a really easy thing to do. But if they don't have one, it means that any reimbursements that they make, technically speaking, are taxable income to the employee. So if they're reimbursing for mileage, but they don't have an accountable plan in place, they're supposed to be then including those reimbursements as taxable income on the employee's in the employee's wages. So they would be, like it says there, it's considered to be wages. Accountable plan, an approved plan that must meet 3 IRS sanctioned rules. I don't think they have the rules here, but like I said, you can download these plans. I think 2, what is it? What are the 3? Let's see if they say here. No. Oh, we can put this one. Let's see if they'll give it to us. So expenses, here are the requirements. Expenses must have a business purpose and be allowable as deductions to the business. So, for example, memberships are no longer deductible. So that country club membership that I talked about, if an employer, a for-profit employer, paid for a country club membership, that would not be considered a deductible, like country club memberships would not be considered a deductible business expense. So if the employer reimbursed an employee for country club membership, that could not be under an accountable plan. So the employee has to pay tax on that amount. It's considered to be wages. But things like mileage or hotels for conferences, meals if you're on the job, if they're reimbursing your traveling, airfare, if it's all business related, that would be considered a legitimate business expense. So that's the first thing. Substantiation, employees must substantiate the expenses with receipts, invoices, or other documentation within a reasonable period. That's a requirement. And return of excess. Employees have to return any additional amount back to the employer. So my example of, they sent me down to Miami, I only spent $2,000, I pocketed the other $1,000, I would have to return all $3,000 or the additional $1,000 in order for it to fall under an accountable plan. Okay. So this is all a distinction. Not that an employer can't do those things, it's just that the tax rules change. Right? So if it's not under an accountable plan, then it's considered to be taxable income to the employee. All right, so some payments that are exempt from withholding. Again, so this is going back to, these items are, let me find it here. Whoops. So items that are, I think it said not exempt, before calculating withholding. Oh, I'm sorry. No, now we're looking at certain payments and payments to certain individuals from law excludes. What is this? I'm confusing myself now. Oh, okay. So these are things that are exempt. Okay, so these are exempt payments. And this is in your book. I'm not going to go through each and every one of these. So what do I want to talk about here in particular? Okay, so educational expense assistance, I mentioned this. If education maintains or improves an employee's skills required by the job, then it's unlimited. Non-job related educational assistance up to $5,250 a year can be, or I think they can also repay student loan up to $5,250 a year, tax-free. So it won't be included in the employee's taxable wages. We already talked about accountable plans. Employer provided parking, this is if they have to pay for it. So if the employer pays $300 a month, and this happens sometimes in downtown areas or in bigger cities, obviously parking can run very, very high, and employers pay for it, up to $300 a month would be considered exempt. So if you work in downtown New York City and you have to pay $1,000 a month for parking, which probably wouldn't be out of the question, and your employer pays for it, $300 of that payment will be exempt, but the other $700 will be considered taxable income to you. Let's see, what else do I want to talk about here? Retirement and pension plans. So any employer contributions to a plan, whether it's an IRA, a 401k, a 403b, any of those different types of plans, any amount that the employer pays into that is exempt from income tax withholding for the employee. Yeah. Mm-hmm. Yeah. Yeah, I mean it. Then you're getting into some questions of other issues. But yeah, ministers have some unique rules, tax rules. They have some for their expenses and things like that. They've got some unique rules.
I've seen some ministers that have like even private.
Yeah. 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 Well, their parishioners maybe need to do something about that. Let's see. Moving expense reimbursements. This is an area you used to be able to, like, if your employer told you we're going to relocate you. So say you work for Principal in Des Moines and they want to relocate you to Denver, and they pay for your relocation expenses. That is taxable income to the employee. It didn't used to be. But that was one of the changes as well that happened in the 2017 law. there were some benefits, tax benefits to the 2017 law, but there were also some tax increases to that. But yeah, so retirement, this is the employer portion, it's not, it becomes taxable when you retire and you start to draw the income out. That's when it becomes taxable. But any amount that the employer pays is not taxable. So just like with the parking, if let's say you live in a city where there's a light rail and you get a commuter pass, is it time? Nope, not quite time. Okay. If you live in a city where there's light rail and you pay for a monthly transit pass, your employer can reimburse you for that pass up to $300 a month. It's like what would they call them in? I don't want to call it a trolley. It's yeah, you too. Not really a subway because it doesn't go below ground. It's like a rail, but it's
What's a rail?
like a train. It's like a train, yeah. They're like parallel to the roads. Or there. So like Minneapolis has light rail, Denver has light rail. Chicago has they call it the L. I suppose it's light rail because it's not a subway, it's an elevated railway system. But it's transit, it's not for long distances, it's for commuting. So cities and you can get monthly passes for them. I don't know if Kansas City has light rail or not. But you can get monthly passes so that you can just, you ride, go to work, come back. Your employer can reimburse you for up to $300 a month, and it's not taxable to the employee in that case. Let's see. Okay, cafeteria plans. This is a particular type of, it kind of is a combined fringe benefit, and it's a fringe benefit, but they're usually combined employee and employer paid. Cafeteria plans are a certain type of plan. They're oftentimes called I think it's a 125 plan. And all of those numbers refer to a place in the tax code where it's described. So cafeteria plans will always include medical and health types of benefits, kind of welfare type benefits. Accident and health insurance, medical reimbursement plans, group term insurance, dependent care assistance, and health savings accounts. So these, again, usually if an employer has a cafeteria plan, they usually hire an administrator to administer the plan and to make sure it's in compliance with all of the necessary rules. But having these benefits inside of a cafeteria plan provides employees and employers with certain types of tax benefits. Okay, but it's these types of benefits that are in these plans. So it makes them pre-tax. So for example, the health insurance. So if you have an employer that provides health insurance, and maybe you have to pay a portion of it. So your premium is $1,000 a month. You have to pay $500. Your employer pays the other $500. The $500 that your employer pays is not considered a taxable benefit to you, so you don't pay any tax on that. And the $500 that you pay reduces your taxable income, so it gives you a tax savings. So there's that's why it's an example of how it's kind of both an employer provided and an employee paid benefit. Self-insured medical reimbursement plan. This is where the employer it's not insurance. They have a pool of funds that they use to pay out medical expenses for employees. That as well could be under a cafeteria plan. If the employee has to pay toward that, it's non-taxable, or it's pre-tax, so it gives them a tax benefit, and plus the amounts that the employer pays are not taxable to the employee. Group term life insurance. So employees oftentimes employers will provide life insurance benefits to employees. The beneficiary of that life insurance, so if you die, somebody gets the money, they're called the beneficiary. The beneficiary of that life insurance is up to the employee. It's not the employer. The employer is not the beneficiary. It's usually the family members of the employee. The premiums that are paid for that life insurance are non-taxable. The benefit is non-taxable to the employee to the extent that the benefit is under $50,000. Once the benefit, the death payment, is over $50,000, then some of that premium would be taxable to the employee. Dependent care assistance. These types of accounts, these are similar to a flex account. Flex accounts would be in there too. Dependent care assistance is where an employee can have money, and this is all employee money. Employee can have money withheld from their paycheck. It gets diverted into a special savings account that they then use to pay daycare expenses or dependent care expenses. So you have $200 withheld from your paycheck. That $200 gets sent off to an administrator. Then when you incur $200 in daycare expenses, you submit for reimbursement and you get your $200 back. There's a delay in all of that, but the benefit is that that's tax-free money now. You do not have to, it reduces your taxable income. If you were just to pay it and not get reimbursed through a dependent care assistance, you would get the dependent care tax credit. There's a tax credit for dependent care expenses, but it's not nearly as generous as this. It's not dollar for dollar. This is dollar for dollar up to $5,000. You're still paying for it, yes, but you're getting a tax benefit from it. It also saves on Social Security and Medicare taxes. Health savings accounts works kind of in the same way. You have money diverted into an account that is then, when you draw on it for medical purposes, it's tax-free. You don't have to, yes, you are putting the money in, but you now don't have to pay tax on that income. So all of those can be part of a cafeteria plan. So pre-tax salary reductions, this is what I was talking about. This is the right-hand side of that table that I showed you. So any contributions that employees make to cafeteria plans are pre-tax. So they're not included in the taxes. So it kind of works differently. So this was a fringe benefit that's being added. In our example here, we've got, so wages of 1,000. You've got some benefits, so some pre-tax benefit that is being paid by the employee. The employee is paying it. So they're paying $100. Now their taxable income for calculations is $900 instead of $1,000. Their taxes have just gone down. Yes, they've paid this $100, but presumably whatever that $100 is, they're going to pay it anyway. Might as well be pre-tax. Might as well get a tax benefit from it. Yeah, so this is a different type of, if you do not spend that $5,000 in dependent care money at the end of the year, you forfeit it. It goes away. So you have to plan ahead. You have to know that you're going to use it. Otherwise, it's gone. Same thing, this is another flex spending account is for medical expenses, works the same as the dependent care. Again, you use it or lose it. If you don't spend, so you can contribute, well, in 2023 it was $3,050, I think it's $3,200 now. You can contribute that amount, and there's all types of things you can spend this on, over-the-counter types of stuff too. But if you don't use it, you will lose it. You forfeit the money. Health savings accounts, I just mentioned that a little bit. So health savings accounts are another type of savings account where it would be a pre-tax benefit. It gets diverted into a special savings account that you use for medical expenses. But the health savings account is special because you can contribute more to it. So you can have more tax savings. However, you have to have a special type of health insurance called a high deductible health plan. And presumably, and you can't use the money in the health savings account to pay the premiums on the health plan. You can only use it for medical expenses. But presumably what it does is lowers the premiums, although in my experience it really doesn't lower them very much. But the savings account then helps you to pay that deductible, the amount that you have to pay yourself. And then retirement contributions. I've already kind of talked about retirement contributions. There are all different types of retirement plans that employers can set up for employees. Any amounts that employers contribute are a non-taxable fringe benefit. Amounts that this is important. Amounts that employees contribute toward retirement plans are pre-tax for federal income tax purposes, but for Social Security and Medicare tax purposes, they are not pre-tax. And you have problems in your homework where you have to figure that out. So for federal income tax, you would subtract, this would be the taxable amount. But for Social Security and Medicare, that would be the amount. You don't get to subtract the 100. So your base for each is different. For each tax is different when we're talking about retirement account contributions. Okay? Let's see. That's it. I got through it. Okay. Monday. We may have a shortened class period. I don't need to record this. Just real quick.